Start the webinar. So good afternoon. My name is Philip from Nathan Trust. I head up the client services team here. On the call with me is David Bruton, who's a chartered tax advisor and heads up our accounting and tax team in Nathan Trust. Hi, Dave.
Hey, Philip.
So just a bit of housekeeping. The webinar is in a Q&A format. So there's an option to ask questions in the bottom of your screen there. So please ask your questions, ask as many of them as you want, and we'll do our best to answer them as clearly as we can. This will also be recorded. So after the webinar is finished, we'll send a recording around to everybody that signed up for it. For people, and obviously we're available on email or to contact if anybody has specific questions. So before it's just I guess the question that we keep getting, Dave, and I see it was sent in to me earlier, is just around the tax treatment of RSUs, and are they taxed twice?
I suppose yes and no. There's two tax events with RSUs, but the same amount doesn't get taxed twice. So what happens on receiving or when the RSU converts to a share, that is taxable. It's subject to income tax, USC, PRSI. It's seen as part of your income from your employment. So it's taxed at that point when you receive the share, and that's taxed through payroll. Your employer has an obligation to deduct that and remit it over to revenue. And then subsequently, if you decide to sell the share, there's a capital gains tax event. So if there's a gain on the disposal, the gain is taxable, and the gain is calculated as the amount you sell it for less the value that was put on the shares when you received them, the amount that was subject to income tax when you received them. So there are two taxable events, but the same amount isn't taxed twice. So at the second event, it's only if there's a gain over and above the value that was put on it when you received it, that there's capital gains tax calculated on it.
Okay, so on the first tax is taken care of by your employer, whereas the second tax you are obligated to pay yourself.
Exactly. So the income tax that's calculated on receiving the shares through RSUs is done through payroll. And then subsequently, if you sell the shares, that's capital gains tax. You'd have to figure out if you got a capital gains tax liability, you've got to pay that over to revenue, and then you include it in your income tax return for the following year.
And you have to pay that. Okay, so you pay it straight away as soon as you get the money, the capital gain. So you sell the shares, you get the money, hit your bank account. Do you have to pay it straight away then?
So the way it works is that if the disposal happens between January and November, you pay the capital gains tax in December. And if the disposal happens in December, you pay it in the following January. And then for the whole of the calendar year, you put all of the information together and you put that in your tax return for that year. Okay,
and there's always a favorite question I see, it was emailed in earlier as well, is how will revenue know that you have to pay this tax? It's self-assessed, so can people just get away with it? Or what's your experience with that?
So I suppose on the RSUs, first of all, it goes through payroll, so your employer just has to deal with it through payroll, and revenue of full details of that. Likewise, if anyone had share options, your employer is obliged to notify revenue of the detail of all employees who are receiving share options. So revenue will have details of that. And then in terms of the capital gains tax, it is self-assessment in the sense that it's up to you to calculate the tax liability, pay it over to revenue, etc. I suppose what I'd say is, we'd always advise people to be compliant. It's much better just to deal with the tax and pay it, rather than having an issue with revenue a couple of years down the line where they're maybe looking at your tax returns and asking questions and things haven't been dealt with properly. There's interest, there's penalties, there's stress involved. It's much better just to deal with it on time and pay the tax over to revenue.
Okay, so the message you're getting is that revenue are very aware of this, and it's not something that people can really stick their heads in the sand, and this is something that revenue will find out.
I would work on the basis that they'll find out. I suppose one of the things that happens is that there's a representative body called the Irish Tax Institute, and they meet with revenue and they discuss ongoing issues. And one of the things that revenue have been flagging to them as an area that they're becoming interested in is the whole area of share options, share RSUs that employees are receiving from their employers. So generally speaking, what revenue will do is if they find that there's an area where they believe there's compliance isn't as good as it should be, they'll do what they'll call a project, and they'll start casting their net fairly wide and looking at how to improve compliance, I suppose, is generally their main concern, but then also to see if there's been underpayment and to look to collect that.
Okay. And you're under the impression that there has been underpayment in this area, and it's something that revenue are paying more attention to.
Yes. So I would expect if you look at, say, for example, share options, the employer has to return details of it to revenue, but the onus is on the employee to file the tax and to pay it. So I would imagine what revenue are seeing there is maybe some discrepancies between what's being returned by the employer and what's ultimately being returned and paid by the employee. So yes, they're seeing the whole area as an area of interest, or maybe an area of concern, I suppose would be fair to say.
Or a quick win.
Yes, absolutely. I mean, they've done this before in other areas where they've figured out that there's a widespread issue, and they've gone in and they've gotten good returns out of it. And
Okay.
then subsequently the compliance, which is probably their bigger concern, the compliance improves thereafter, you know?
Yeah. Okay. Okay, so a couple of questions in here. If you have RSUs that will vest upon company IPOing / listing, but are no longer with that company when the event occurs, is that company still responsible for the withholding tax via payroll?
If they're RSUs, then yes, my understanding is that they are, and there's guidance on how they would do that, but they would have to, my understanding is they would have to still apply payroll taxes to it. If it was share options, that wouldn't be the case.
Okay, so with RSUs, but so you can, even if you formerly left the company's payroll, they can still pay you. They can still have an active payroll with you, or is there a complication there from a bookkeeping perspective? Or
I suppose what it's maybe akin to is if you take someone who's left employment, let's say they finished up in December, but they're due some sort of a commission or a bonus that gets paid in arrears, even though they've left, the employer would still be obliged to operate payroll taxes on that bonus or commission. So it's similar to that in that sense, that the obligation remains with the employer to operate payroll taxes on those RSUs.
okay, so the short answer to that question is yes, it will act as if your RSUs will be, the tax will be paid as if you were working for the company.
Yes, in the vast majority of cases, you may have a situation where someone's moved abroad or something like that, and the situation may be different in a case like that.
Okay. It's a good one here, which is something we deal with quite a bit. Are the RSU tax rules to people non-domiciled in Ireland, or are there any benefits in that area? So maybe if you just want to give us a quick explanation of what's nondoms, and then talk about how RSUs, the benefits for people who are getting RSUs.
So a non-domiciled person is someone who's living in Ireland, tax resident in Ireland, but isn't considered to have Ireland as their central home or their main place of connection. So typically it would be someone who's moved here from elsewhere, and they retain that connection with their country of origin. And it's generally country of origin, it's not always. So someone who's not domiciled, the tax rules in Ireland would say that they're only taxable on their Irish source income and their foreign income or gains to the extent they bring it into Ireland. So where you've got a non-domiciled individual and they're receiving RSUs as part of their package from their employer, they're taxed in the same way on receiving the shares. It's thereafter that there's a benefit to them. So if they've received those shares, they pay tax on them the same as someone who's domiciled here. It's if they then hold those shares, let's say they're working for a US tech company and the shares are held in E-Trade in America and it's in an American company, they've now got an asset that's sitting outside of Ireland. So if they dispose of that asset and there's a capital gain, if it was you or I, we'd be paying capital gains tax on it at 33% in Ireland. But because they're non-domiciled. If they choose not to bring the money into Ireland, they don't have an Irish capital gains tax liability. It'll only trigger if and when they bring that money into Ireland. So they are able to defer or avoid an Irish capital gains tax liability on share disposals indefinitely until they bring the money into Ireland. And if they never bring it in, they never trigger that liability.
Okay, and what happens if they so they sell the shares and there's a capital gain and they keep it outside the country and they say want to invest in cryptocurrencies or something like that, or property, or there's a capital gain on that secondary investment.
Yeah.
Is there a tax activity on that too?
It depends on what the secondary investment is in. So let's say they take that money and they go and put it in shares, for example, in the US or the UK or anywhere else. Then no, there's no tax on a gain on that secondary asset. If they put it in property in, let's say, Italy or Germany or wherever, again, if they dispose of that, there's no Irish capital gains on that disposal, even if there is a gain, until they bring the money into Ireland. Cryptocurrencies is maybe a little bit different. It's not very clear how a non-dom is taxed on a cryptocurrency in Ireland. Revenue haven't really given us guidance on how a non-dom is taxed on that. And what I mean is where is the asset considered to be located? So if you take shares in a US company, let's say Google, it's clearly a US asset. Or if you buy a house in France, it's clearly in France. If you buy cryptocurrencies, it's not clear where it is. So revenue haven't said where they consider it to be located. HMRC in the UK have said that they consider the cryptocurrency or crypto asset to be located wherever the holder is resident. So if you take someone who's non-domiciled in Ireland and they dispose of shares and then they use that money to buy cryptocurrency and they dispose of that cryptocurrency, that's potentially subject to capital gains tax in Ireland, but it's not definite at the moment. It's unclear, but I would say there's certainly a high possibility that could be looking at capital gains tax in Ireland and that disposal.
Okay, and as a rule, revenue would kind of follow where HMRC lead revenue would follow a little bit, wouldn't they?
They would. I suppose what they would do is they would look at HMRC's guidance, they'd look at the reasoning behind it, and they'd see if they'd any reason to differ. It would be certainly seen as a strong indicator of how it may be taxed here. I wouldn't be surprised if revenue put out guidance on it at some point, but I suppose, UK is bigger, you have more taxpayers there, so the question tends to get raised sooner there.
Okay, and yeah, just on the non-dom aspect of it as well, is it generally quite cut and dried who's a non-dom, or is there complications? Is there legal requirements? Is there a legal definition of what a non-dom is?
There's no legal definition, so there's nothing. It's not very black and white in that sense. So I suppose if you look at someone's tax residency, it's very clear. You've got very set rules. It's black and white whether someone's tax resident or not. With a non-dom, what you're looking at is you're looking at previous cases that have come before the courts, previous cases before tax commissions, and you're using those to interpret certain factors that would indicate where someone is domiciled. So I suppose if you took two scenarios, let's say you've got someone who moves here from another country and they go back to the country they previously were from on a regular basis. They've got family there. They're maybe saying, look, I'm moving to Ireland for 5 or 10 years for work, and then I'm planning to move back to my home country. That would kind of indicate that their domicile has remained in their home country. If you take someone who's moved here, and let's say they're here for 10, 15, 20 years, and they're quite settled here, and they're saying, look, I'm staying in Ireland. I'm not planning on living anywhere else. I'm going to see my days out here. It's the only country I'm going to live in from now on. Then that would indicate that their domicile is quite possibly changed to Ireland. Generally speaking, it would have been that you'd have to show that they've moved to the new country, that they intend to live there permanently, and that they've severed connections with their previous country.
Okay, and the kind of work that we do around this, we're working with a lot of non-doms and advising them, and because essentially if you're taking the position that you've got a sizable capital gain, but you're deciding not to pay tax in Ireland, even though you're a tax resident here, you need to make sure you've got all your ducks in a row, really, don't you?
You do, yeah, absolutely. So it's, I mean, what we would do with a lot of people is we'd sit down and get them to explain their background to us, their current situation in terms of family, living, working, where their assets are, where their connections are, how often they return to their home country, all of these sorts of factors, and we'd weigh them all up, and then we'd tell them where, in our opinion, they're domiciled, whether it's Ireland or whether it's a different jurisdiction. And we'd also say to them, look, here are the things that you need to be aware of over the next 5-10 years that may indicate that your domicile is changing, or here, you know, or that your domicile hasn't changed. So it's really, I suppose, a matter of understanding it first, and then being aware of what may color the position in future. And
it's also about being careful, because like with future assets, because what we're seeing happen is that individuals are in a lot of cases making a considerable amount of money. It's sitting in a brokerage account in the US. They don't really want it sitting there. They might have to get the money out of there in a certain time frame. They're putting it into cash and they're looking to reinvest it in stock, shares, ETFs, things like that. But in fact, some or a lot of those investments could actually be Irish domiciled and could trigger a CGT activity unless they're careful. Isn't that what we've seen on a number of occasions?
Correct. So I suppose, I think, you know, to me, the two ones that people really need to be careful of are the whole area of investment funds and ETFs, because, as you say, an awful lot of them are domiciled in Ireland. So even though you may be looking at an ETF that's, you know, connected with the S&P 500 in the US or the NASDAQ, that could still be domiciled in Ireland and considered an Irish asset. So you need to be very, very careful around those. The taxation of funds in Ireland can be quite complicated. So I would tread cautiously there. And then also, I think crypto assets is the other area where people are maybe unaware that the asset could be considered an Irish-based asset, depending on how revenue interprets the HMRC's lead on that.
Okay, and just another question here. If I understand correctly, then there is a 33% benefit for RSU sales for non-domiciled people. Is that the same for stock options, for example, on a cashless exercise, or does it only apply to RSUs?
So it would apply to stock options as well. So again, if you take the stock option, it's similar to the RSU in that when you exercise the stock option, you'll be subject to income tax, USC, PRSI on the value of the stock option, less anything you've got to pay at that point. So you'll have to pay that in Ireland because it's connected with your employment in Ireland. So then you've now got the share in the company, and if you subsequently dispose of that, the treatment is exactly the same as RSUs. So if you're non-domiciled and you don't bring the proceeds of the disposal into Ireland, you would have a 33% gain there, in the sense that you're not paying Irish CGT at 33%.
Okay, all right. So it's a good place to be, but as advice is, tread carefully and get your planning done beforehand.
Yeah.
So I guess we're coming up to about 20 minutes, which is normally how long we do these. Okay, we just got another one in there. Keep them coming. We'll stay on as long as people ask questions, within reason, of course. Are many people filing RTSO1s within 30 days? I've heard of several colleagues who have never filed any returns for their stock options.
My impression is a lot of people aren't filing them. And the reason I say that is, again, if you go back to revenue, so they've got a list from an employer saying, here are all of the individuals who've received share options or who've exercised share options. And then they've got people's tax returns, and I suspect they're not seeing the RTSO ones coming in versus what the employer is telling them. So I suspect that's why they're now focusing on this area. So I think at the moment, a lot of people don't. I think, to be fair to people, there's a lot of uncertainty people have around how they're supposed to deal with this. And I think sometimes with the employers, they don't always provide very detailed guidance, because it could be a big US company with employees all over the world, and they maybe don't get into the specifics of the Irish tax treatment of these share options or RSUs. So I think, I think, yeah, in short, a lot of people aren't filing them.
So
To me,
isn't what we're seeing is that, like, so the employee who, like, is PAYE, all of their taxes taken care of by their employer. The employer in a lot of these US companies, they're fantastic employers in that they take care of an awful lot for their employees. And then suddenly they've got a tax liability that they do deal with themselves, and their employers are possibly afraid to get involved because that might trigger some liability if they're seen as being very hands-on with getting their employers to pay self-assessed tax. So we've dealt with a lot of the US companies, employees from the US companies, helping them with this, and we've never really seen any of the companies, and they're the biggest. They go from like the 500 employees to the 50,000 employees. None of the companies are helping the employees at all with this, are they?
They're not. And I mean, even if I think sometimes the employer will give some guidance to the employee in terms of a fact sheet or something like this, but it tends not to get into the detail of here's exactly what you've got to file and when you've got to file and when you've got to pay the tax to revenue. So I think there's genuinely a lot of people out there who are unaware of their filing obligations. And in some cases, I think there's people out there who are unaware that they've got a tax liability they haven't dealt with.
I'd say, Dave, in fairness, now you're probably the only person on this call that would read a tax fact sheet given to them.
Yeah, bedtime reading.
but I think that's I think that question alludes to a known issue, and that's the work we're trying to help people with is, and it is complicated. And like you'll see on the website, we do provide the service of tax returns for 495 and RTSO ones. We do help people with this because, you know, we can do it reasonably straightforwardly, but for someone who's a developer or a HR person or a salesperson, it's just inherently complicated, isn't it?
Yeah, absolutely. You're dealing with it once or twice a year. You know, so I think people just don't like dealing with it.
No. Okay, just one here too. ESPP is a share option. ESPP is a share option, ? And the taxes are paid on the difference between the market price and the purchase price, ? Thank you for this, by the way, very helpful. You're welcome.
So the ESPPs can be structured in different ways. Some of them can be structured as a share option. So I suppose the difference is, if you go back to share options versus RSUs, with the share option, the employee ultimately has the choice as to whether to exercise the option or not. They can let it lapse. So if the ESPP is structured like that, where you've got to say, yes, I'm accepting the shares, then it's structured as an option. Whereas if it just happens and you don't have to accept it, it's structured more like an RSU. So that dictates the tax treatment. If it's structured as an option, then you're back to the onus being on the employee to calculate the tax and pay it to revenue. It's not done through payroll, and you've got to file that RTSO1 and you've got to put it in your tax return at the end of the year. Whereas if you don't have the option to decide whether you accept it or not, and it's more like an RSU, then your employer will deal with it through payroll, and you don't have the filing obligation of an RTSO1.
Okay, and will your employer make that clear to
you? Hopefully. I've seen differing levels of communication on it with employees.
Are stock options ESPPs to be returned by revenue as an RSS1?
Yes, that's my understanding. Yes.
Yes, this is great. We're getting all the acronyms, all the tax acronyms thrown in here. Okay, I think that's probably us done. Thanks for all the attending. Thanks for all the questions. If you want to get in touch with us to help with any of this, just we're easy to contact on the website. If you don't want to buy any of our services but found it helpful, feel free to Google Nathan Trust and then give us a good review. That's always nice to get and helpful across the board. And other than that, again, Dave, thanks for your great advice and for your attendance.
No problem.
And we'll send everybody the recording, and we look forward to speaking to you.